You are listening to the Will Power Podcast. Welcome to the show. I am Will Holdren, and I talk with some of the most influential CEOs, entrepreneurial leaders, and thought leaders to reveal the secrets that have led to their success. I believe that with the right knowledge and mindset, you can do anything you say your mind to. So if you want to learn how to change your life for the better, if you want to learn how millionaires actually became wealthy, or if you want to develop and start your own business from the ground up with the right knowledge to help you, then you are in the right place because this is the Willpower Podcast. How's it going, everyone? My name is Will Holdren. I am the host of the Willpower Podcast. Today we have an incredible entrepreneur that I actually met at an Atlanta real estate conference last weekend. He is doing a lot of amazing things in the real estate arena. And his name is Tom Liravongsa. And Tom is actually the managing director of a company called LCRE Global. And what they do is they acquire and buy skyscrapers all over the United States. And it's an amazing thing to get into, and he's been crushing it. So I'm absolutely blessed to have him on here today. So with that being said, Tom, thank you so much for joining me.
Thanks for having me, Will.
Yeah.
Titles on companies, just so you know, the banks, they require titles, right? But managing directors means there's like other partners and there's not. It's actually myself and my investors. So to clarify that part, because people get confused when you see managing director.
Gotcha. You're the one giving yourself that title. So basically,
Yeah, you got to when the bank asks who are you, you got to put something down.
yeah, that makes
So
sense. That makes sense. Well, I appreciate you jumping on here. I loved everything you're talking to me about before when we spoke at the conference last weekend. And so jumping into things, I want to go into your background a little bit. So what was your childhood like and how did you end up becoming an entrepreneur, or were you always an entrepreneur?
sure. So this is one of those stories, and I'm sure you've heard it before. It's like if I can do it, anybody can do it. That's the truth, right?
Yeah.
And this is kind of one of those stories, okay? And so my parents they immigrated here from Thailand, and they came over just like anyone else. And when you get here to the States, they just send you off, say you're going here, you're going there, and that's how they created these pockets of communities. And when my parents started here, they just thought, okay, they just need to work. And it was like a de facto, you would go work at a factory. So my mom gave me my first, like, let me do my first job. And it was in a factory, but it was a chicken factory. Okay. And this was back before everything was like automated. Okay. So I'm a senior in high school and I'm working in a chicken factory. And uh, nowadays, like the egg never sees like human hands. It comes right out of the chicken and goes into a carton. Back in the day, the egg would come out of the chicken onto trays just covered in,
Oh,
chicken shit. And then I would have to take these trays and lift them up onto my chest like chin high. And then I put them in a big washer and it would like spin all the egg crap out and I'd have to put it on this conveyor belt. I was the first of the line of this factory, okay? And I
wow.
remember taking a tour of this factory and I was walking along and the guy was telling me like, all right, yeah, look, as you move up, you can go here, here, and here. And then finally I get to the end, right? And the guy says to me, he says, man, this right here, this spot is where you want to be. This is the boxing spot. It's the cleanest and it's cool because you got a refrigerator next to you. And he goes, finally, I got here. It took me 15 years to get to this spot. And I looked at him and I said, 15 years? And I
Oh,
looked back and I could see my station. And I looked back at him and looked back at my station and I said, oh, hell no. I'm not going to go from there to here in 15 years. And so
oh,
at that point, I realized I never wanted to work like in a factory and like literally my goal was to get from here to there in a spot where you could physically see. I said, that is not a goal in life. I said, I need if I'm ever going to work in a factory, I'm going to own this factory. And so
yeah.
that kind of triggered my mindset into saying, okay, I got to own stuff. I got to do stuff. And that led me into like this entrepreneurial path.
Yeah. That's yeah, that's quite a story,
So
quite
now we went from chicken farm to skyscrapers, like
right.
that's the scale, right? So
Yeah.
but yeah, that's kind of the entrepreneurs like that moment. That's what it was.
Yeah, well, that's and like you said, it's a pretty cool come up going from chickens to skyscrapers. So congrats on making that transition.
Yeah. Yeah.
But post high school, what was your kind of first entrepreneurial endeavor that you got into?
Um, it it was I think I started doing a quarry, a marble quarry back in Thailand. We had a family member that had a big marble quarry.
Mm,
And um in that marble quarry, our family member had this giant like I don't know if you've ever seen a quarry, especially marble quarry. It's kind of really unique, just huge blocks of marble. And I thought, okay, I'll do this one first, where I'll basically import these marble slabs into the U.S. and sell them to home builders and tile places and all these different things. And so that was like my first deal. Whereas, like, I filled up a container. I started with like a 20-foot container, just like a shipping container. I learned a whole bunch about customs and importing and all that stuff very quickly. And so when that was like the first kind of entrepreneurial piece that I did
yeah,
was like doing that. And then I realized uh, that took a lot of work. It took a lot of like footwork. I had to go to a lot of stores, I had to call a lot of people, and I realized like I need more. I need to be able to reach more people a lot quicker than that process. And then I
yeah.
started going digital and kind of progressing from there.
Okay, gotcha. So how do you transition from that to getting into the skyscraper business? I mean, what was that journey like?
So progressively, going from like the basically doing sales, okay, meeting people and trying to sell all the marble that I had,
Yeah,
I realized then, I like I said, I wanted to get to do more. So I started moving into this digital space where I started doing a lot of graphic design, and I started doing a bunch of logos and all these different pieces, okay?
yeah,
Then I realized as that progressed, I started leaning in towards kind of designing advertisements and things like that. All right. And then I had this interesting idea that I would do a magazine. And it was like a inner city kind of magazine focusing on like downtowns and stuff.
yep,
And that was like pre 2008, and nobody was spending any money on ads. And so what was happening was I put all this money, I took my parents' money, everyone's money to just do this magazine. And then what ended up happening is I ended up losing all of it because nobody was spending any money. And so uh, after that, I had moved in with my brother-in-law and my sister at the time, and I was just bumming out.
oh
And
wow,
I was living upstairs in their duplex. And like by the third or fourth month, I was just sitting in the sunroom, like eating their cereal, being a super bum, right? And then I'd asked my brother-in-law, I said, I was like, hey Quinn, like how are you paying like the mortgage? Like I don't pay you rent. So like
right,
how are you doing this? And so he goes, I started trading, and he was trading currencies. And the reason I share this is because in trading those currencies and understanding that process, he says, look, I like took 10,000 off a credit card and making 4,000 a month trading. I thought, oh, that's a lie. That's a joke. No way. And so I started watching him. And back in the day, like trading in 2010, 11 in currencies is the same as like Bitcoin back then was like trading at $10 kind of a stuff, right? If
yeah,
equivalent when you think about trading. And
mhm,
so I share that because um, there's more to that story. But what happened is we ended up creating a fund because we needed more money to trade because we were doing really well. And then that fund had grown to a pretty substantial size, into the billions. And so from there was a regulation that had came out in like 2013 called Dodd-Frank. That destroyed a lot of hedge funds, actually, a lot of what we call high frequency funds, which is what we were. And so I had to shut that fund down. When we shut that fund down, I ended up transitioning into real estate. And that was probably about 5 years ago. And so um, that's kind of like, I condensed it a little bit, but it
Yeah.
basically went from hedge fund work uh, into skyscrapers. But here's the thing. The reason I had brought up the idea of going to like the digital advertising and stuff like that is because what I realized is part of um, raising money for hedge funds is a lot of how good material looks and how you present it, because the returns of a hedge fund typically are the same. One hedge fund might produce the same percentage as another, and there's a lot of them. And so it's really about how you present yourself. So like going into that digital space really was the segue into how well we made our material, which made it a lot easier to bring in investors. So that's why I brought that up.
Gotcha. That's a very good point. And I think a lot of people raise money or try to raise money in different areas. And like you said, it's very unprofessional how they come up with that proposal to go out and to pitch an investor to give them like $1 million or whatever that number is. And like you said, it makes it that much harder if your materials aren't that, well designed. Like you were talking, you have that marketing background, and I can see why that
Right.
could definitely help. And it's always crazy to me listening to entrepreneurs' background and how they got to where they are. And for you, I mean, it's crazy. In 2008, you're living on your brother-in-law's couch, and that's when you kind of figured out, okay, I'm gonna get in this currency space and do a hedge fund, which to me is
Yeah.
crazy. And like you mentioned, at that point, it was kind of like Bitcoin was a while ago. It's like it's risky, right? It's not like a well-known thing of how to do it. But for people listening, I mean, if you could dumb that down, like, I mean, how did that currency trading underlyingly fundamentally work?
Okay. So in currency trading, back when I say back in the day, I'm talking like a period between 2009 to about 2012. Okay. That was
Yeah,
like a golden period. Whereas all the tools that you use to trade, things called Bollinger Bands or simple moving averages like SMAs, all these tools that you have at your disposal, they followed them. Trend lines followed like there was no tomorrow. So you could literally see where trades were happening because the volatility is what we call it was very predictable, meaning there was not as many traders in the market as there is today. Back when I was trading, volatility ranged between like 2 and 4% movements in a day. Now they average like legitimately, they average like 10 to 12%.
wow.
So when you have those big of swings, you can't put as many trades in, so you can't do as many positions. And so that's the big difference of what it was like back then. Is you could track everything a lot easier. Like it would be what we call technical trading. There's two types of trading: technical trading and fundamental trading. Fundamental trading is like how most people trade today, which is macroeconomics and speculation, as compared to technical, whereas you follow mathematics. And so that's kind of part of my background is a lot of mathematics. And so um, that is what has dramatically changed in the past like 5 to 8 years is that process.
Gotcha. And so when you guys were trading these currencies, I mean, I'm just trying to fundamentally understand this, but so you guys are buying some foreign currency in one instant, and then literally like a second later, you're selling it in a different market where the currencies aren't really the same value quite yet. And that gap in between is really the profit that you guys are making, essentially.
Yeah, so they call this it's arbitrage.
Yeah.
The specific kind we did was called triangle arbitrage. There is some uh the triangle arbitrage would be the easiest one to explain. So basically, we would do 300 trades like every day at least, and our trading window is pretty short. Like we trade 24 hours, but um, it would be spread through all over. What would happen is exactly like what you said. You buy one person's trading from another location differently. Like uh you'll buy a euro dollar. That's an example of like a currency trade. Okay. Um, one house would be trading it for $1.20 and another house is wanting to buy it for 125, and then you like make that spread selling it from one to the other like instantaneous, and
Yeah.
you just do that hundreds of times and just move money. We call this a market maker. And so that's what we would be doing is like we'd be providing liquidity by throwing our, hey, we have this, we're selling at this, and then people would just be buying it. We just do those trades all the time.
Yeah.
So that is that kind of trading doesn't happen as much today. Like I said, now it's like people are just saying, "Oh, I think that the dollar is going to be strong today because I'm going to say Trump's president, so they'll take a long position on dollar and they'll be selling it against euro, something like that."
Okay,
So
gotcha.
yeah,
Yeah,
does
I
that
mean,
make sense?
yeah, it's definitely a unique way of making money. And like I said, I think a lot of people
Sure.
they know that it's a thing where you can do currency swaps and make money doing that, but it just goes over their head sometimes. So the next thing I want to ask you is
Yeah.
obviously you got started in that, and then you said you guys just turned the fund into billions of dollars, which to me is a crazy jump. So first of all, how are you finding these people that want to invest in what you're doing? How hard was it getting this fund off the ground and just initially raising that capital?
Okay, so this is like Fund 101, okay?
Yeah.
So if you want, whenever you start trading, let's say you want to start trading, you want to run a hedge fund, okay? You have to know what your end game is. You always have to know like where's the goal. If when you start trading and your goal is like, well, I just want to trade my own money for fun, then you're never going to start a fund, okay? So when you want to start a fund, you actually have to have the vision of like, all right, I need to bring people's money in if this strategy works. So step one is you have to track every single position, brand new account from like day one. Okay. And you just keep tracking that. And then you go on these platforms. There's all kinds of different platforms that you can go on. For example, the easiest one to go on is called Morningstar, for example. Like you
Mhm.
can go on there and upload like your results over and over and over all the time. And eventually, like it takes a 3-year track record before you can start ramping up funds. Institutions like these are endowments, pension funds, things like that. They can't fund you uh, typically legally, like unless you have a 3-year track record, and or it's just a requirement that most of the large funds have is like a 3-year track record, and then like the average out of that. So you when you start the fund, you have to have your strategy completely what we call systematic, meaning you have to know from start to finish. This is how the trade happens. This is what we do. This is how it works. Never deviate from that. You audit that return. And if you have a new program, you completely start a new account. Otherwise, you cannot start a fund. Okay. So that's like rule number one. And then you got to get to that 3-year mark. The first 3 years, you're going to end up just trading. You'll get some feed from like Morningstar and things like that. But ultimately, like nowadays, social media is very strong in getting new people. You can just showcase your trades, and some people might ask you to trade your money for them, stuff like that. So you have to want to be like a trader, number one. Um, so once you do that, just know like in the first 3 years, you might cap out like at 10 million to 20 million, something like that. And then at the 3-year mark, you just start ramping up like 100 million, 200 million, especially if your track record's strong.
Gotcha. Okay. So
But
it
like that's the actual process. Yeah.
yeah. So it's not something quick and easy you can just jump into and obviously raise that amount of cash. It's just
Now,
time.
even if you made 100% a year, it does not matter. We did 42% a year audited for 3 years before we broke like 100 million.
Wow.
So you have to like you can they just it's a due diligence process. You would not get institutional money. You
Yeah.
might get some, but you have to go to like a lot of shows and things like that. But you have to be able to raise capital too and speak to your program. But if you're the trader, you're going to realize like you're either trading or you're raising money. So you kind of have to decide, who you are in that process.
Gotcha. Well, obviously it worked out for you guys in the long run. And fast forward those 12 years, you mentioned some new legislation came out that ultimately
Mhm.
pretty much ended your guys' fund. So what was that transition like for you going from being known as the hedge fund guy into real estate? I mean, how hard was that transition? And why did you decide to get into skyscrapers of all the ways you get into real estate? Because I think a lot of people they think, oh, multifamily, single family, but skyscrapers is not normally one that crosses their mind. So why was
Sure.
the type of real estate vehicle you wanted to get into?
Yeah. Okay. So let's first understand the definition of what a hedge fund manager is. Okay. So like a hedge fund is just going against whatever everyone else is doing. If they're trading in the market, someone's trying to find yield somewhere else. It's your job as a hedge fund manager to find yield. Okay. However that return happens, that's what you're looking for. So the transition from investors knowing we can make money over here and we can do really well is always an easy segue into saying, well, this didn't work for this reason. That's why we're shutting it down. but we want to shift over here because here's what we see as a shift in the market. And it's actually a lot easier because you can say, just like we experienced in this other fund, when we first saw it over here, we're seeing it over here. So you got to know how to sell that product, if that makes sense. And
Hmm.
so in this scenario, real estate was taking a very unique shift in like 2019, like pre-COVID, like right before it kind of pre-COVID and then going into COVID, and you were buying like in 2019, 2018 to 2020 thereabouts. This was really good, really, really good pricing because everything kind of skyrocketed from there. All
Yeah,
right. So
definitely.
in this scenario, you don't, I don't, I don't think I ever looked at a skyscraper and said, "Oh, I want that one day." I don't actually know if anybody says that because,
Yeah.
they look at that, and unless you come from a family that does that, you don't think, because I mean, you've seen this one that I have, right? Uh, the one in Chicago is like 42 stories, like 500 feet plus, right?
Hmm.
So when you look at that, I mean, the number in your head is probably thinking like double digit millions, right? So,
Yeah.
like, what would you think if you recall that tower that's like, 557 feet?
Right. A lot.
So would you say it's like 50 million, 70 million? Most people kind of think like that's what it is. And that's
Yeah.
a dead stop for a lot of people. And so with that said, I don't like go and I look for that I wasn't looking for those. What I was looking for was value. And I was looking for cities that are really friendly to wanting to do housing. Okay. And need housing. And I was also looking for cities that were struggling in office. And I was looking at migration. It's all there's logic. There's often math behind a lot of this, in the sense of you can see what cities need. You can see where the influx and outflow is happening. And so in this scenario, we found that certain cities are really primed for a turnover. And turnover would be office to residential. And so that's kind of where I was leading. And again, prior to us talking, I was talking about, you know, the deal that you're looking for kind of determines like where you're going to find cash and how you're going to grow is making sure you find the right deal. And so, um, knowing that these cities had these opportunities, that's kind of where I started going into. And then realizing that there's opportunities there, that's when you can find investors to do these deals with you because well, they're not privy to them, but they're also not looking for them. They didn't know they were there. Isn't until someone presented to them and said, "Look, there's a good deal here that actually is of interest." So it's like it's because the opportunity presented itself at the right time. That's how skyscrapers came to be. It just so happens to be they're all skyscrapers because cities are what we call insulated in a lot of ways, where they're uh, protected from market fluctuations because people either condense there or uh, the pricing is stronger in those markets.
Right. Like you said, it's pretty protected as a real estate asset. But so like you mentioned, so let's say someone found a really good city they want to invest in, and you were talking about, okay, now you got to go out and find a deal, but how actually do you find that deal? Because it's not like you can find a skyscraper on the MLS that you can just look at
Yeah,
and put
right,
an offer on that one. So first of all, how do you
right.
find those deals, and how do you run the numbers just by looking at a skyscraper, wanting a skyscraper? So how do you run those numbers? What potential net profit could be, so you can be confident enough to go out there and actually pitch an investor to get in on something like this?
Sure. So I'm going to simplify just a little bit, okay? So
Yep.
first we'll talk about like you asked me first like how did I find it, right?
Yep.
So your your attorney and your accountant are very important people in your arsenal when it comes to finding big scale deals. Okay, they're often privy to like these potential foreclosures and things like that. Also, your large scale contractors are also a great part because they're doing the work, and a lot of times they're floating that work, and they're the first to tell you that things aren't getting paid, and you can gauge where a project is at, if it's kind of prone for a takeover, because there's just not enough funds there to complete that project and or make a turnover. So it's kind of like you want to spend time in that realm. Your attorneys, your architects, your anyone in what we call MEPs, mechanical, electrical, plumbing, like your contractors essentially that are doing large scale stuff. All right. Again, I was sharing with you, you're not going to get that if you're doing like a foreign unit. You got a handyman. He's going to tell you that he's doing some big old project for like 30 grand in a skyscraper, you see?
Right.
But if you go to a big guy and they're like, these guys owe me like $2, $3 million, that can really help you narrow down like, oh, there might be an opportunity here. So
Okay.
you gotta have to get creative in that.
Okay. That makes sense.
Okay, so the other one is, um, I was actually gonna do a quick little video on this, so it's good you're asking me this. So like
Yeah.
simple math, okay, on like how you pencil out a deal, uh, is like different per type of asset class. Okay, so you've got your what we call MSA, which is metropolitan statistical area, or your core downtown areas. Okay, then you've got your secondary markets, which are kind of just like burbs, and then you got tertiary, which are like more rural. These are different classes. And as you move further out, you go from a luxury to a class A to B to C. Okay. That's kind of the structure of that. Now, in each of those structures, each of those things are um, priced differently per unit. When you talk to brokers and stuff like that, they're going to not talk about necessarily like uh, what the cap rate is on the project or anything like that. They're going to talk about a per unit pricing. So, like in downtowns or MSA areas, you're going to find pricing anywhere between, depending on the city, between 300,000 a unit to 500,000 a unit. Okay, so that's like a gauge there. When you go into the secondary market, you're going to find pricing between 180 and like 250. All right, and then further down from that, you get to Class C's, you're going to be like in the like 150s and 180s. So in each one of those segments, it kind of flows down differently. Core MSA areas, um, they're going to price a little higher, and you're not looking for as strong of a return, because you get, in exchange for return, you get stability. Okay, because you remember I said you're insulated, so you don't have as much fluctuation in pricing. As you go further down, you have a little more fluctuation in pricing, and so you get better pricing. All right, there's like uh, what we call like a 10% rule in multifamily,
Mm.
and that is whatever you pay for like a unit, you have to think, if you're paying in let's say a secondary market or something, and something is trading at 2,000 a unit or 200,000 a unit, okay, 10% of that, let's say you average rents per unit about 2,000 a month, right? Simple math, right? And so if that's the case, uh, what you can do with that, I usually try to be like 15%. You want to average like uh, above 12, 15 is great, of the price per unit that you can get on average on rent. And or if you know you can get it there, that's when you talk about like value add. Does that make sense?
Yeah.
So if you have a value add, then you can get it to that pricing, like even above it is even better. Okay. Uh, so in this scenario, if we did some simple math, right? Let's say you've got 100 units, okay, and you're at 200,000 a unit. So 10% of that, let's say you're making like 2 million, actually a little more than 2 million a year. So um, 2,000 units times 100 units, right? Times 12, and you should be at like 2.4 million, yeah, in
Okay.
gross income. Okay, just round numbers, right? This is the simple math.
Yeah.
Uh, take take. I want to do it at 15%, just for everyone. Like to make your deal pencil well, you want to be at 15% of that 200,000.
Okay.
Okay, you can make it work at you can make it work at 10%, but that is if you're getting closer to the MSA area, okay, where your rents you get less vacancy and you have less work to do. Does that make sense? Okay.
Yep.
So 200,000 at 15%, you're going to be bringing in about 30,000 a unit, okay? And then you multiply that by 12. So you're making and then times that by 100 because I do everything based off of 100 units minimum, okay?
Hmm.
You should bring in like 3.6 million, okay, in gross income. Did you follow that?
Yeah.
Okay. So now, simple rule. There's more detail if you want to get more detail, but I'm making simplified. You cut that in half, okay? So if we're cutting the 3.6 million in half, this is what you have available for mortgage, about 1.8 million. All right. So now in that basis, um, in your when you're looking at your mortgage, okay, there's like assumptions you're gonna make, like 6% interest, 30-year amortization at a 1-2 debt coverage. Okay.
Mhm.
So what that means is if your net free cash flow, your NOI is 1.8 million at a 1-2 debt coverage, okay? The loan amount that you should be able to take is like $21.3 million. Okay. So that's how much your loan should be able to support. That's a very good deal because typically, if you're buying 100 units and you're paying 200 a door, you're in the money. Does that make sense? Because you're getting a loan for $21 million. So um, that's actually a very, I take that back. That's a really unrealistic scenario because you never get more loan than what the building is worth. So you probably end up paying a little bit more for it.
Yeah.
Okay. Because, uh, you know, you're talking 200 grand a unit and 100 units is 20 million thereabouts. But you're looking at trading between like 20, you'll probably end up buying it for like 20 to 24 million. Okay.
Hmm.
And so what ends up happening is um, you'll end up having like your mortgage would be like 1.5 million. Okay.
Okay.
And so you'll have leftover cash flow of like $300,000. Right. So your investors that are giving you that money to buy that property, let's say you're buying it for 22 or 23 million dollars, they're going to want to see like 10 to 12% of their money. Does that make sense?
Yeah.
Okay, so if you're getting a loan for 20 to 21 million, you have a gap that you need to raise for about 2 to 3 million dollars. Does that make sense?
Yeah. That does actually.
Okay. Yeah. So you want to make them 10 to 12% on their money. Okay. That's like the average growing rate for units that are over 100. Um, when you're doing smaller units, they're going to want bigger returns because there's more risk to them. At 100 units, there's less exposure because you have a lot more units. Does that make sense?
Yeah. Yeah.
Okay. So if you were to repencil this deal, like simple mathematics, can you get to make 15% per unit on your rents average? If not, can you make 10% on your units per average? Like can you make 2,000 a month average if you're paying 200,000 a unit? Does that make sense?
Hmm. Yeah.
Okay. So that's like a really quick and dirty way to pencil a deal out to see if you can pay your investors a strong return, which is plus 8%
Gotcha.
on a yearly basis. Okay.
Got it. Okay.
So,
So,
damn, that was really complicated. I'm sorry. I try to make that simple. I think I made that real complicated. Hey, man, you're talking to a hedge fund manager. We're talking tens of millions of dollars every day.
yeah, I mean,
So,
I think
uh,
you simplified that as much as you possibly can when you're talking about numbers that big and all the moving parts. But yeah, I mean, it's crazy to me you can just raise 2 to 3 million, which is very plausible for people, right? And then you can just get the loan for the other around 20 million that you need, and you can jump into the deal like that.
yeah. Now, here the other part to it though, the is that 20 million, that's where you need like a partner to write that check with you, like to sign, to let's say, well, you found a deal, right? And you're like, this is a great deal. This thing pencils like 15% per unit, you know, and
Yeah.
like this thing juices out. would you be able to go to the bank and ask them for a loan for like $21 million?
I was going to ask you, yeah, how do you do
Right. So
that?
that's like half the problem, right? So you just worry about getting the deal, and then what will end up happening is like you'll partner with people like me, and I'm like, oh, I'll totally sign on that loan with you, right?
Yeah,
And then we go get the loan, and then we together raise the $3 million, and we're splitting all the rest of the income. Because remember, we're getting management fees. There's all kinds of other ways to generate income off of that deal.
gotcha.
Okay.
So
Yeah,
in that scenario, there'd be a couple people personally guareteeing that loan that you're getting from the bank.
that's right. Yeah, it depends. If it's over 100 units, it's a non-recourse loan typically. You get what's called bad boy carve-outs, which is basically like if you do something fraudulent, that's when you're in trouble. Otherwise, it's not personally guaranteed.
Okay.
That's why you want to do bigger deals, man, because they're tied to the asset. The bank, in theory, doesn't actually care anything about you. They care about if the deal can cash flow. They care that you underwrote it properly and that you know how to present the deal. That's what they care about.
Yeah. Gotcha. Well, that's pretty amazing. Well, looking at your story, I mean, how many skyscrapers have you done? I know you said you've been in real estate for 5 years now, but how many skyscrapers can you do in like a 5 year time period? Like, what does that look like?
So building two, okay, and then rehabbing four. So that's all within that time frame. When you build skyscrapers, like we're building one in Austin right now that's 80 stories, 804 feet.
Wow.
That one is most tower developments are 10 to 12-year turns. Most people don't realize that. They take a long time to put together, from entitlements to pricing a project out of that scale. I mean, that project's like $700 million. And so they take a long time. Um,
Yeah.
but they're they're in the process of being built. So in 5 years, you could do a lot. Rehabs are a lot cooler to do because the structure is already there, and you're just rehabbing, just like any fix and flip. You're just doing a whole bunch in one
Right.
building in one place,
Just
right? So you
bigger
got
scale.
economies of scale.
Yeah.
Yeah, yeah.
That makes sense. And typically like per skyscraper, I mean, what are like when you're analyzing and underwriting these deals, I mean, what do you want to see like net NOI looking like when you do one of these skyscrapers?
It depends on different factors. Yeah. So like you always want to be above 100 units, number one. Okay. Um, this is like a golden rule because, as what we call the sponsor, the one that puts the deal together, at 100 units, you're making right around like 100 grand net on the deal for just putting it together in perpetuity, like as the deal keeps going. That's like number one. On that basis, that NOI is typically north of 3 million, okay? Like minimum, right? So that's like a basis. But in skyscrapers, your NOIs are typically closer to like 8 to $12 million.
Wow. Yeah, that's pretty
Yeah, and
phenomenal.
that's between, call it 330 units to about 450 is like the typical size over about 450,000 square feet gross.
Okay.
Yeah,
Gotcha.
that's about a, you know, 40 to 50 story tower in today's standards.
It's pretty big. Uh,
Mhm.
and before we run out of time, just got a couple more questions for you. So when you're
Yeah.
looking to structure these deals, let's say you found a deal, you found people to personally guarantee that loan for you to get things started. Now you're going out raising the capital for the to actually get the deal across the finish line. From a business structure, I mean, what do you need to do from business wise to make this work? I mean, are you creating like a whole new LLC company and then offering out partnership interest in that company, or how are you structuring that for these other investors
Okay.
to do it?
So this is what we call creative structured financing. A lot of times these deals that require rehab, and or if there's 10-year developments, you're going to have a lot of raises. Okay. So it's hard to structure a fund around that timeline because the IRR would change dramatically. All right. The IRR represents um, internal rate of return, which a lot of investors can gauge what their return would be, and or they set a hurdle on what they want for the return. So um, you create everything as like one-off special purpose entities, uh, and or a special purpose vehicle just for the deal. So you'll create a special purpose entity, which is like a one-off LLC that usually starts off the deal. And then you have this SPV, which in terms of vehicle in the hedge fund space, that's part of how you can grow your hedge fund is making sure you put them in the right vehicle that could come in as a convertible note, come in as a promissory note. Um, uh, it could come in as a second lien position, first lien position. All those pieces come into play. Each one of those, you have to determine the type of investor. So, like convertible note investor, you might be able to give them. The reason you would do a convertible note or a promissory note is because you have a short-term bridge because you're trying to get to a larger construction loan. Okay, so you'll end up creating these like vehicles that are structured as like, hey, this is just a promissory note. This is what this part looks like. This is when the payoff is. These are the extensions and so on. Okay.
Yep.
Then these convertible notes are because you don't have the LLC formation done yet. You don't know how much money you need yet. You have a generalization on what they convert into, at which point they would just convert into the LLC that you would create if you needed to raise more money down the road. Okay. When you raise more money down the road, that's when you have these LLC structures where they're doing subscription agreements and they're just buying essentially units into whatever amount raised that you're needing for. So if you need a $10 million raise, you break up those units depending on what your minimums are, and then they'll just be buying those unit shares, and that would essentially get them into the LLC to get their Class A shares.
Okay. That was a good Cliff Notes version for how
Yeah.
complicated that structure is, but that makes sense. What does SPV stand for real quick?
Special purpose vehicle.
Special version. Okay. Gotcha.
Okay. That's a type of instrument that you want to put them into. It's very important that you know the structure when you're talking to big family offices, let's call it, or big
Yeah.
money guys, that you know what you're going to be putting them into, because then they know where their risk stands. If it's convertible note, they know that they can have equity to deal. If it's a promissory note, it's going to have a higher interest rate because they're not tied to anything typically.
Okay. Okay. Yeah, there's obviously a lot of terms and lingo, like you said, that can
Hmm.
make or break it. For you
Yeah.
personally, obviously you've done close to 6 deals now in this time frame, which is fantastic, especially in the skyscraper realm. But looking forward for you, I mean, what are some of your big time goals that you're trying to hit, over the next couple of years, next decade? What does that look like?
So, do you remember I told you that it's very important that you know like your process. If you're going to start a fund, you're going to start a fund. Yeah.
Yeah.
So it's all about understanding the vehicle. Okay. At the end of the day, each of these asset classes, okay, which are each one of them are over, $250 million. The one alone in Austin's like 1.4 billion. Each one of these deals, once you hit a threshold of 1,000 units and or $1 billion, depending on what it is and the cash flow that it generates, you're going to wrap everything up ultimately into a REIT. And the reason you would do that is because we want to, as investors, be able to exit our position yet still maintain control and cash flow from that asset. And so there's different ways to do that. You can sell it, you can refinance or whatever, but even if you refinance it, you're still leaving juice on the table, right? Meat on the bone, let's say. But if you put it into a REIT structure, then what's ended up happening is you're able to offload a lot of that position. So each one of these things, the future goal is to wrap all of these into a REIT, depending on the type of asset class, and just do multiple billion-dollar REITs, and then ultimately just have a $5 to $10 billion REIT portfolio.
Wow. I love that. I love that goal. That's fantastic.
Yeah.
Yeah. Well, I appreciate you sharing all this knowledge, and I'm sure a lot of people listening are going to get a lot out of this. Before we wrap up, is there anything else that you'd like to say? And if people want to reach out to you, how can they go about and find you?
Um, the best way to do it would be to follow me on like Instagram under skyscraper guy. That's an easy one.
Yeah.
Not so much TikTok because I think they're gonna shut it down. But if they are on TikTok, it's the skyscraper guy. Um, and then also there is a platform that I've been working on that I put together with some people that I've hired to just follow me around and write down all these different notes. I call it 100 unit club because I keep mentioning like 100 units the minimum. And it's just an investment club. And so it would be, you can email like Tom at 100unitclub.com. And that would be a great spot because we're going to be turning on that platform pretty quick. That will essentially be a lot of free resources for people to underwrite their deals, to get, you know, material and the same material that I use, um, and learn how to do like these large scale deals. Because ultimately, if I can share with you how to do a deal, then what will end up happening is when you find that deal that I can't find, I would hope that you would say, "Hey, Tom, I have a deal." And it's like, it's this deal. This is my cousin or my brother, whatever it is, right? And
Yeah.
then all of a sudden we're doing, you know, a couple $100 million and you never even knew it was even an option for you. That's why I create that platform and show people essentially in a lot of ways for free how to do it, so that you can bring a deal so we can work together. So that's just under 100 unit club.
Awesome. Well, you guys definitely check that out. Join that club and give him a follow on Instagram. And with that being said, Tom Liravongsa, thank you so much for joining me today.
Awesome. Thanks. Well, appreciate it, my man.